Assalamu alaikum and welcome to you all to day 3 of practice to pass F4 English law. So in the previous 2 days we have talked about certain topics from the syllabus, and all the handouts are available in the handout section. You can have them for day 1, day 2, day 3. And today we would be talking about some more topics. So for the students who have joined today, uh, as far as the exam is concerned, you would be given choices in the exam, and you'll have to choose from those choices. You will not have to type anything, even in the MTQs. So this was for the students who joined today. The rest of you, of course, know that already. So let's move on to some more topics. And yesterday we started with a little introduction of partnership after agency law. So, so let's move on with the topic of partnership. Partners, as you all know, are agents of the company as well. Partners are agents of the company as well. So what exactly is a partnership? When we talk about the definition of partnership, so what exactly a partnership is? It is the relation which subsists between persons carrying on a business in common with the view of profit. With a view of profit. So the relationship is going to be between people, persons, as you can see. So it is minimum of 2 people required, minimum of 2 partners required, and they're supposed to carry out any business. It could be everyday trade, occupation, profession, can be a single transaction as well. At times, the partnership could be for a single transaction as well. And there should be a view of profit. There should be an intention of profit. So if there is any arrangement between people and they have no intention of making profit, that would not comprise to partnership. Partnership has to have an element of profit in it. Partnership has to have an element of profit to it. So how does the partnership is formed? Uh, is there any formal procedure for that? Like companies, no. It could be very informal, very informal. But if you want to make sure, you can refer to the particular act. That acts I'm going to talk about in a while. Otherwise, it could be very, very informal. And if you feel like, you can come up with a written partnership agreement where you can put some express terms to override the implied terms. We have talked about terms in our previous session. So this is partnership, and the element of profit should be there. So how many types of partnerships are there? I gave you a hint yesterday as well. Well, there are 3 types of partnerships. There are 3 types of partnerships in your syllabus. You should know all about all these 3 types of partnerships. Some of the partnerships are the partnerships which are governed by the Partnership Act 1890, which are governed by the Partnership Act of 1890. Traditional partnership, the partnership that we all know about. Minimum of 2 people is required. Well, that is for all sort of partnerships. Then there are some partnerships which are formed according to the Partnership Act of 1907, and there's a name to that partnership. Those partnerships are called limited partnership. Limited partnerships. And then there are partnerships which are governed by the Partnership Act of 2000, and they are known as limited liability partnership. Well, there's a difference in limited and limited liability partnership. So three sorts of partnerships. Well, in the Partnership Act, which is governed by Partnership Act 1890, well, this is a partnership that comes by default. If any partnership does not fall under this act or this act of 1907 and 2000, it automatically falls under this act of 1890. All the partners, all the partners have all the partners they have unlimited liability. They would be liable for the debts of the partnership personally as well. Unlimited liability for all the partners. All the partners. Partnership by Partnership Act 1907, known as limited partnership. Well, in limited partnership, we have one partner who is known as a general partner, and that general partner has complete unlimited liability. Unlimited liability, and the rest of the partners, well, they can enjoy limited liability, like a company. Limited liability. Of course, the other partners who are known as limited partners with limited liability, they do not have that much say in the management. The general partner is going to be the main partner because he is the one with the extreme unlimited liability, and he would be the one making most of the decisions for the partnership. Coming to limited liability partnership, it is just like a company where everybody has limited liability, so all the partners in this sort of partnership, they have limited liability. They cannot be forced to pay for the debts of the partnership like it is done in the General Partnership Act. Like it is done in the General Partnership Act. So these are certain types of partnerships, and that brings us to certain types of partners. Types of partners. Well, one of the category is general partner. General partner, a normal partner with unlimited liability. If the partnership is unable to pay the debt, they'll have to pay the debt. They have unlimited, complete unlimited liability. Then we have a sleeping partner. Sleeping partner is the partner which is not that active, not that much active in the decision making of the company, in the of the partnership, in the management of the partnership. Well, they say that we are here just to invest and get our share from the profit. They do not take part in the running of the partnership, in the management of the partnership, or in the decision making. Then we have limited partners. Limited partner, well, as I told you, in limited liability, they are the ones with limited liability, and these partners do not have that much say in the management. No basic contribution in management or running of the partnership. Why? Because they have limited liability. They have limited liability. So these are certain types of partnerships and certain types of partners. So have a look. So how does a partnership ends? Well, on the death or bankruptcy of a partner, on the agreement between the partners, and passing of time. If the partnership is for a particular time, when the time lapses, the partnership terminates. Let's see what these questions are about. Which of the following statements regarding partnerships is correct? So let's see if you can come up to an answer. A limited partner may lose his limited liability if he begins to be more actively involved in the day-to-day business of a limited liability partnership. An incoming partner immediately, well, we'll come back to this question because we have not studied that liability of the partner so far. So, next question. What is a partnership according to Partnership Act 1890? A relationship which subsists between two people carrying on a business in common with a view of profit. A relation which subsists between persons carrying on a business in common with a view to profit or loss. A relation which subsists between persons carrying on a business in common with a view to profit. Well, the answer is, let's see if you guys can come up to an answer. Well, the answer to the question is C. C is the answer to the question. So let's talk about the liabilities of a partner. As we all know that partners are agents. So agents have certain authority, certain liabilities. So what are the liabilities of the partners? Certain rules that you should know regarding the liabilities of the partner. Okay, so what is the condition? Let's begin with a general rule. General rule. Well, according to the general rule, all the partners are liable jointly and severally for the debts of the partnership. For the debts of the partnership. So all the partners in a company, in a partnership, they're liable for the debts of the partnership jointly and severally. Partners are liable for each other's acts under the rules of agency. The rules are summarized again so you know all the rules. So what is the condition when a new partner enters the partnership, and what is the condition when a partner retires from a partnership? Now this is important regarding liabilities. So whenever there is a new partner in a partnership, the partner becomes liable for the debts incurred. The partner becomes liable for the debts incurred after he has joined the partnership. After he has joined the partnership. So he is not liable for the debts incurred before the date of his joining. He would be liable for the debts of the partnership after he has joined the venture, joined the partnership. So whenever there is a new partner entering, he should know that he would be liable for the debts incurred after his date of joining. Retiring partner. whenever a partner retires, so as a general rule, as a general rule, the partner should not be, retiring partner should not be liable for the debts after his date of leaving, his date of retiring. So that should be the case generally. He should not be liable for the debts after his date of retirement. However, he is. He is liable. Why? Because if he retires, he has to inform all the contracts, people, all the related contacts, people who are already with the people who have been already dealing with the partnership. So the retiring partner has to inform them. Until and unless he does so, he would be liable even for the debts incurred after his date of retirement. So he can do this, but the retirement to be informed to be informed to all the people in contact, to all the contacts, existing contacts. So if there is a person who has been dealing with this partnership and he is not informed about the retirement of the retiring partner, well, he can hold the retiring partner liable for his debt. So that is the situation for the retiring partner. So these are the rules regarding the liability of the partners. General rules for a general partner. What does the Partnership Act says for the general partner? Number one, what does the Partnership Act says for the retiring partner? Number two, and what does the new partner? And what does the Partnership Act says for the retiring partner? You should know all these rules. So we all know that partners are agents as well. So agency is also mixed up with the partnership. Partners are agents as well. So have a look at this flow chart. Whenever there is a contract with a third party and the third party has claim against the payment, third party has a case against you, against the partnership, and they want the partnership to pay them for the contract, and the partnership is denying, the firm is denying, the firm is saying, no, we do not have to pay you, the individual partner has to pay you, we have not given the authority to individual partner. So court will have a look at these situations, that does the individual partner has the authority or no. If he is going to have any sort of authority, the firm is liable to pay, and if he has no authority, then he will be paid. So the first question, so let me just place it over here like this. Let's see, let's make our own flowchart. Well, what are the conditions when the firm will pay? Third party needs the money. What are the conditions when the individual partner will pay? Individual partner will pay. So the court is going to ask a series of questions. So let's see. Question number one, what the court is going to ask is, did the partner have actual authority? So court is going to see that if the partner has actual authority under agency under Partnership Act. So if the firm says that yes, our partner has actual authority, yes, so then court is going to ask the firm to pay. If the firm is saying no, this partner does not have any such authority. Then there would be another question. So see, the no does not automatically takes you to this condition that the individual partner is going to pay. It takes you to the question number 2. What is question number 2? Well, the question number 2 is, did the transaction relate to the business? Was the transaction related to the business? Was the transaction related to the business? Well, if it is implied that yes, it is related to the business, the firm is going to pay. If this says that no, it is not related to the business. If it is said that no, it is not related to the business, so what is the condition then? Well, then we'll move on to question number 3. Question number 3. What is the question number 3 that court is going to ask? Would a partner in such a firm usually have authority to do this? Usual authority, implied authority. So would a partner in such firm usually have such authority? Well, again, if the answer is yes, the firm is going to pay. Well, if the answer is no, move on to question number 4. You must have studied this previously in your book as well. Did the partner know or have reason to believe that the partner was not a partner? Did the partner know or have reason to believe that the partner was not a partner? So, did the third party know or have reason to believe that the partner was not a partner? Well, third party knew that partner was not a partner? No. The condition is opposite here. Third party does not know that. If third party does not know that, firm is going to pay. If the third party knows that, well, then we will head towards the final question, which is question number 5. What is that question? Regarding ostensible authority, did the party know or believe that the partner was a partner? Ostensible, apparent authority. Did they believe that the partner was a partner? Was there any reason for them to believe so? Was there any representation from the firm side? Well, if the answer is yes, the ultimate decision is that the firm is going to pay. And if the answer is no, there was no reason that the partnership would believe that the third party would believe that he's a partner. So there was no apparent authority. So in that final situation, court is going to give the verdict that the individual partner is going to pay to the third party. And in this situation, court is going to say that the firm is going to pay to the third party. So these are some series of questions. You might have done that in your studies as well. So that was a quick recap. LLP is just a limited liability partnership, so it is just like a company. So you need to give it has to follow. See, we said that partnership could be informal as well, but LLP could not be informal. It has to be registered under Partnership Act of 2000. It is supposed to have a name, a location of registered office, name and address of the members, designated members who take responsibility for publicity requirements, and they have to file their accounts and certain notices to the registrar, and they will even have to appoint auditors. So they have to follow all the formalities of a company. So why? Because all the liability of the partners are limited, just like a company. So when a partnership dissolves, what is the order of payment at that time? What is the order of payment of debts? Who do you pay first and who do you pay later? Well, the order of payment would be something like this. At first, you would be paying some external debt. For example, you have a debt from a bank, pay that, paying outside debt. Second, you would be paying any advances from partner. If you have taken any loan from the partner, the sort of advances from the partner, then you'll pay that advance, that loan back to that particular partner. Then you will pay the capital contribution of the partners in the ratio, of course. Capital contribution, in fact, the contribution or the ratio, the contribution that they have paid at the formation of the partnership. And if something is left, it is shared as a profit on profit sharing basis. Profit sharing basis. Profit sharing ratio. So this is the order of payment whenever a partnership dissolves and they pay their amount. So all the technical aspects regarding partnerships in front of you. So now let's see some questions. Which of the following statements regarding partnerships is correct? A limited partner may lose his limited liability if he begins to be more actively involved in the day-to-day business of a limited liability partnership. An incoming partner immediately becomes liable for all the debts incurred before his admission. The estate of a deceased partner is not liable for the debts incurred before the partner's death. What do you think is the answer? So you need to come up to one correct answer. Well, B is incorrect. An incoming partner immediately becomes liable for all the debts incurred before his admission. No, he is not liable for the debts incurred before his admission. Well, estate of a deceased partner is not liable for the debts incurred before the partner's death. Well, they are liable. After the partner's death, they are not liable. And a limited partner may lose its liability if it begins to become more actively involved in the day-to-day business of an LLP, and if they choose to do so, they can use the limited liability status. A could be the answer. Question number 2. Well, we have done question number 2. Let's see. You need to come up to an answer in your mind first. As a minimum, which of the following formalities is necessary to form an unlimited liability partnership, a normal by default partnership under the Act of 1890? A written partnership agreement, a decision by the partners to set up business together, registration for the partnership at company's house. Is the registration required? No. Is a written partnership agreement required? No. It could be even with the shake of hands as well. It could be that informal. But what you need is a decision that yes, we want to set up a partnership. B is the answer. Which of the following is true regarding limited liability partnership? That partnership is liable for its own debts. Yes, LLP is just like a company, so it is a separate legal entity that we'll study in a while. So the partnership is liable for its own debts. That's true. The partnership does not need to file accounts. It does. One partner may not take part in the day-to-day running of the business. It can. Where the partnership cannot pay its own debts, the partners are jointly liable. No, they are not. They are not. So A is the answer. Which of the following statements concerning retiring partner is correct? Retiring partners are not liable for any partnership debts after they leave. Retiring partners are liable only for existing partnership debts when they leave, unless third parties are notified that they have retired. Well, they're liable for the existing debts anyways. Retiring partners are responsible for existing partnership debts when they leave and partnership debts incurred after their retirement, unless third parties are notified of their retirement. And retiring partners are only liable for partnership debts incurred after they leave. C is the answer. They're still liable, but if you inform the third parties that they've left, then they're not liable. What is the liability of partners for the tortious acts of each other carried out in normal course of business? Jointly, severally, joint or several, and joint and several. So D is the answer. The word normally used is jointly and severally liable for each other. Partners are agents of each other partners, and of the partnership as well. So this is all about partnerships. If you have any questions, you can ask. So all the rules that you need to know regarding the partnerships. So like partnerships, you have other ventures as well, like sole traders and companies. So sole trader, what is a sole trader, or what does the sole trader venture mean? Well, sole trader own and run business which are not legally distinct from the owner. A sole trader invests in a business, and sole trader enjoys the profit himself and is liable for the debts himself. It is unlimited liability. However, a sole trader can have hundreds of employees. It is not that sole trader has to carry out all the work by himself or herself. He can have employees. So sole trader venture is a different sort of venture from companies, and all the sole traders have unlimited liability. Of course, the one person, one owner, there's just one owner, he has unlimited liability. So legal status of the sole trader, no formality, self-accountability, personal supervision, all the profits are going to accrue to the same person, and well, liabilities would also be incurred by the same person. So that could bring the owner's wealth at risk. So companies are legal entities separate from the natural person connected with them, for example, their members. So you have heard the phrase corporate legal personality, corporate legal entity. So let's talk about companies a bit now. That companies, how do they differ from partnership? And companies are different from partnerships, and all the status of the members are different, liabilities are different. So what are the situations when a company is formed? So there are certain consequences when the company is formed. How do we form a company? We'll talk about later in the next chapter. Well, all the people in a company, excuse me, they have limited liability status. They are, excuse me, they are not liable for the debts of the company more than the investment they have put in the company. So liability of a company and its member is always and always limited. Limited to what extent? There are two types of companies: limited by shares, limited by shares, where you invest in the shares and all you can lose in a company is the amount of the share. You will not be asked to declare your personal assets for the debts of the company, or invest in for your personal assets for the debts of the company. But companies could be limited by guarantee as well. There are limited by guarantee companies as well. Well, what happens is a limited by guarantee company. Well, people, all the members, they are bound through a written agreement. They agree in writing actually at the start of the venture, at the start of the company, and they agree to that. What did they agree to? That they would pay certain amount of money. They guarantee that they will pay certain amount of money at the time of liquidation. If the company is going to dissolve, they guarantee that this would pay this amount of money. So this is how the name comes: limited by guarantee. Limited by guarantee. These sort of companies do not have share capital. These companies have share capital. So this question, that what are the companies which have no share capital? Limited by guarantee companies. Limited by guarantee companies have no share capital. Once the company is formed, the company becomes a separate legal personality, separate legal entity, different from its owners, separate from its owner. Well, from now on, always and always, company's name would be used in all sort of contracts and dealings. The individual's name is not going to be used, company's name are going to be used. Company's name is going to be used. So whenever the company is formed, the company is subject to Companies Act. You're not supposed to remember the dates of the Companies Act. The examiner is not going to ask you about the dates. So the companies are formed under the principle of going concern. You cannot, well, if there are just few members, some of the members or one or two members, they cannot bring the company to an end. The companies, they are formed on going concern, and few of the members cannot end the companies. So companies have separate legal entity. There was a very famous case, Salman versus Salman Corporation. So the key points to remember is that company is liable without limits for its own debts. Members of the company do not have to pay the debts of the company. If it fails, members will have to pay any money still owed from purchasing their shares or under a guarantee. So they'll pay the shares, the called up amount on the shares or the guarantee, not more than that. Limited liability concept. So the name of the members are basically hidden behind a veil. So what is the situation? The members, after the incorporation, the members and their names, they basically are hidden behind the veil of incorporation, veil of incorporation. But at times law says that we can lift this veil as well, and we can bring the name of the members in front as well. Law says yes, there is a veil after the incorporation of a company, but in certain circumstances, certain circumstances, the courts can look through the company to identify the shareholders, the member. The courts can lift the veil and look through. By lifting the veil, the courts can look through the company to identify shareholders. To identify the shareholders. So when a company can lift the veil, there are certain situations. There are certain situations when the courts would lift the veil and would see who are the actual members behind this, and they can be penalized for that as well. So lifting the veil through statute. There are certain statutory conditions when you can lift the veil, or certain evasion of liabilities, when the veil is lifted, and there could be certain conditions in group situations as well. So we'll talk about them one by one, and before we move on to some questions, we need to have a thorough knowledge of all this. So whenever a director is, or a member of a company is involved involved in fraudulent or wrongful trading, so when the court finds out that any director is involved in fraudulent or wrongful trading, so what they would do, that the veil is going to be lifted, and those directors will be penalized personally for doing this. Like if there is a public limited company, public limited companies are not allowed to do trading without trading certificate. But if they have done so, they have started the trading without trading certificate, the veil is going to be lifted and individual members would be penalized for that. Condition number 3 is when there's a disqualified director, there is a director who has been made disqualified under Companies Director Disqualification Act, and he acts like a director and is still working as a director in any company. So the veil is going to be lifted, and the members of that company and that particular director will be penalized individually for this act. And whenever there is abuse of company name, so when does the abuse of company name occurs? What are the rules regarding the names of the company? Well, whenever you need to put a name on a company, you need to adhere to these rules. And what these rules are, the name should not be similar to any other company's name, so that you can mislead a customer. We have done that. We have studied that tort of passing off tort in torts chapter as well. Passing off should not be the same. And if the name is showing any government connection, it should have a valid reason for doing so. You cannot write Royal in front of any company's name. So you should be having a valid reason, justification, that why are you using government connection in your company's name. It should not be a sensitive or offensive name, and it should be it should properly end with words like limited, private limited, or PLC. So these are the rules regarding the name. So whenever you're putting a name for a company, you need to follow these rules. So if these rules are not followed, abuse of company name, you're using any other company's name, the veil is going to be lifted and you will be penalized personally for that. You will have to suffer remedies, penalties, compensation for that. And when does a veil is lifted? In case of evasion of liabilities, when there is some contractual liability. For example, if your company says that after leaving our company, you cannot provide services to our clients, and you have signed a contract. But after you leave the company, you start providing services to the clients. So this is evasion of liability. You need to follow the contractual rules. And you do that, and just to hide it, you hide behind any company's name. The court is going to lift the veil and you'll be penalized personally for doing so. You'll have to account for all the profits that you have already received from those customers. Why? Because you had to follow this contractual obligation. So at times companies do that for evasion of taxation. They hide behind the name, and for evasion of taxation they do that. And for nationality sake, this comes when two companies are in a state of war. So then there is not supposed to be any dealing between them. However, if you do that and hide behind a company's name, that is evasion of liabilities. The veil will be lifted and your name is going to be brought forward. Or a quasi-partnership, you are working like a company, but you are not letting other people to enter, and you have a very, very limited scope. The court is going to say that you're just hiding behind the name of the company. This is actually a partnership arrangement. So if any one person leaves, the partnership is going to end. And then whenever there is a parent and subsidiary companies, there is a group, the parent and subsidiary. Court says that we will lift the veil if we see that subsidiary is just acting like an agent of the group and all of the companies are single economic entity. Single, you need to put word single over here. Single economic entity, or this whole structure is a facade structure, is a sham structure. Sham or facade means, let me just write it over here, fake, made up. Fake structure, made up structure. So in all these situations, the veil is going to be lifted and the individual person's name would come forward and they'll be penalized for that. So there is a veil. It comes by the principle of separate legal entity. Limited, it can be limited by share or guarantee. Private and public, private company, well, you know all this distinction and you have done that in your previous papers as well. So I'm just going to skip these areas. You can read them out. And minimum share capital 50,000 for a PLC, minimum one member and two directors for a PLC, name must end with PLC, name must end with LTD for a private limited company, must have a trading certificate to trade. That is really important. For a public limited, you need to have a trading certificate, otherwise you cannot trade. Well, like limited liability partnerships, we have unlimited companies as well. You can choose to form an unlimited liability company as well, but all the members will have unlimited liability over here. Let's see if we can do some questions. Which of the following is not a feature of a limited company? Directors are always immune from criminal prosecution. The shareholders have limited liability. The company has a separate legal personality. All the companies have separate legal personality. Yes. All the limited company shareholders have limited liability. Yes. Is the answer. You cannot immune any director from criminal prosecution. That is wrong. So what is the minimum requirement for a public limited company of shareholding? Well, 50,000 pounds. So if you know all the rules, the questions would be pretty much easier. You will face some easy problems if you know all the rules, if you can remember all these rules. Okay, so statutory examples of lifting the veil, we have discussed about it, we have discussed about all these things and all that. So you should know how does a company and partnership differ from each other. Company have separate legal entity. Partnerships, they do not have separate legal entity. Members have limited liability. Usually in a company, members have unlimited liability. In a company, members should be at least two and they can be limited to 20. Well, in a company, just one member minimum, and all these things you need to see, and you can read it from here, all these things. It may or may not be registered partnership. Company has to be registered. Let's see. Let's read some questions. Which of the following statements regarding sole trader is correct? A business is legally distinct from the owner. No. All of a sole trader's profits accrue to the owner. Yes. Sole traders do not need to register for VAT. Well, they do. So B is the answer. In a company limited by shares, what is the limit of a member's liability? The amount that they guarantee to pay in the event of the company being wound up, that is limited by guarantee. The amount of share capital they have purchased, including any amounts outstanding on the shares that they own, nothing. The company is liable for its own debt. Answer is B. The amount that you have purchased and you have paid for and even called up. Some of the amount if you have to pay for the debt, you are liable for that. For the share capital, you are liable for that. In a company limited by shares, what is the limit of a member's liability? Limited by shares. Well, I think that's a repetition of the question. Next question. To what extent is a member of a company limited by guarantee personally liable to contribute towards the company's debts? He is liable to contribute towards all the company's debt at any time. He is liable for all the company's debt on a winding up only. His liability to contribute is limited to the amount he agreed to upon a winding up. Well, the answer is C. He agreed that he would pay this amount if the company wound up. That is the amount that he has to pay. So we'll head towards a break. Well, this session will resume at 11. Okay, let's head towards the next area of your syllabus, and that is company formation. So now we'll see all the rules regarding company formation. So when the companies are formed, separate legal entity is identified and the name of that entity, that is the company, is basically then used for all the legal purposes, for all the contracts, for all the dealings, and name of the members are hidden behind the name of the companies. However, at times the courts decide to lift the veil and the individual members are brought forward, and basically all the situations are seen in the light of that. So let's see, how does a company form, company formation. So when you need to form a company, well, in the first phase, what do you do in the first phase? There has to be one person, and who is the promoter. Promoter is the person who brings up the idea of forming a company. Promoter is the person who brings up the idea, a person who undertakes to form a company for a specified purpose and takes the necessary steps to create it. Those who act solely in a professional capacity are not promoters. So if anybody it comes under a professional capacity, for example, if the person is a lawyer, an auditor, a consultant professionally, so they cannot become a promoter. Promoter comes up with the idea and takes the steps to form the company. And generally, promoters act like agents. We have read about promoters in agency as well. So promoters generally acts like agents, and they have certain duties to perform. Promoters have certain, uh, sorry, not duties to perform. There are certain duties that the law has placed on the promoters, and they have to follow those duties. For example, some of them could be the showing duty of adequate skill and care, disclosure of interest. If you have any other interest in the company other than formation of the company, you need to disclose that. Duty of not to make wrongful profit from wrongful means, that is also one of the duty. And you need to do avoidance of conflict of interest, that is also another duty on the promoter. However, the promoter is the person who sees all these things and then goes for the formation of the company, and the promoter bears certain expenses. They are known as pre-incorporation expenses, and these expenses under law, they are not reimbursed to the promoter. He has to bear all those expenses by themselves, not reimbursed. This is the law, but once the company is formed, the situation can be changed as well. Pre-incorporation expenses cannot automatically be recovered by a promoter, but once the company is formed, the company may agree to reimburse. Reimbursement is not allowed in law, is not an automatic right that the promoter gets, but the company can give that right to the promoter. Moreover, during this phase, promoter has to have certain pre-incorporation contract in his hand. purported to be made by a company or its agent at a time before the company has received the certificate of incorporation. So, certain pre-incorporation contracts are also formed. Pre-incorporation contracts these contracts are also formed, and these are the contracts which the promoter enters before the company gets its certificate of incorporation. Before the company gets its certificate of incorporation. So the company is not formed, so technically the company is not bound by the liability under pre-incorporation. So company is not bound by pre-incorporation contracts because company technically has no certificate of incorporation, has not been formed. So company is not bound by these contracts. Pre-incorporation contracts. Who is not bound? Company. Company is not bound. However, promoters are personally liable for these. Promoters are personally liable for these because they have entered into these contracts. Promoters can get away with this liability. Promoters can get away with this liability by certain means. For example, if they just sign a draft agreement or they put a term in the agreement that we are going to sign a new contract once the company is formed, or when they are going to buy off the shelf company. Off the shelf company, the companies that are already made, you just go and buy them. So you do not have to go through all these registration formalities. So this is the first phase, and the only important person, in fact, the only person over here is promoter. Promoter. So once the promoter is done with all this stuff, incorporation expenses, incorporation contracts, then the promoter goes to the registrar for registration. The next phase is the registration phase. Registrar would demand an application where you would write the company's proposed name. What do you want the company's name to be? Is it a public limited company or a private limited company? Is it limited by share or limited by guarantee? Guarantee. What sorts of company do you want? What is going to be the address for the registration of the registered office? So promoter goes to the registrar for registration, and he submits an application to the registrar, and this is the content of the application. And then registrar would ask for certain documents. Basically there are 5 documents, and a registration fee which approximately is £20 approximately. So what are those 5 documents? Memorandum of association. A memorandum of association is a document which is signed by the subscribers. Subscribers are the initial shareholders of the company. So subscribers sign this MOA and say that, tell to the registrar, to the promoter, that yes, we intend to form this company. And yes, we are subscriber of this company. And then they at least 1 share each. They're going to get 1 share each at least. And then the MOA is signed. So this is the first document. First document, and who signs the MOA? The subscriber signs the MOA. Then AOA is drafted. We'll talk about AOA in a while. The detailed internal rules and regulations are drafted in an article of association. You can use a model article of association, but if you do not want to use the model article of association, you can draft your own article. So this is the next document. And then statement of proposed officers. It gives the particulars of first directors and secretary. If you're a PLC, secretary is a must. So you need to put the information of director and secretary in this statement. Then the statement of compliance, that we are going to comply with the Companies Act. And then statement of capital. Statement of capital and initial shareholding must be completed by all the companies. So these are the 5 documents that are required. 3 statements. Statement of compliance, statement of officers, director and secretary, and statement of capital and initial shareholding. So these are the documents that the registrar requires, and once he's okay with all these documents, he gives you a put your name in the register of companies, give you a certificate of incorporation. Certificate of incorporation is granted. Registration number is granted. A name is granted. And if you are a PLC, you need to get trading certificate as well, and then you can start trading. You can start trading, the company is formed. So within what period of time after the year end must a private company file its accounts within the registrar? 9 months. 9 months is the time period you need to file your accounts with the registrar first time. Which of the following must sign the MOA? Who signs the MOA? The subscriber and all the directors, subscribers and at least one of the directors, subscribers and the company secretary, subscribers only. The answer is, well, subscribers only. So there's one question by Saif Ali. I hope Saif, though your question is being answered. All the recordings are available. Okay, subscribers only is the answer. Subscribers only. So commencement of the business. So once the company is formed, uh, you're supposed to maintain certain registers and annual registers and books and returns, and you're supposed to maintain those and inform the registrar annually about all the annual return. You need to get back to the registrar, and you have to maintain the registers at your end, and the registrar is also going to maintain the register at his end. So there's certain register that you're going to maintain throughout the life of the company, and every year you would be returning with the returns, annual returns, to the registrar. What are those register? Well, members register, which will have information about the shareholders, and if it is a limited by guarantee company, the members give the guarantee. Then we have directors register, name of the directors and details. Directors have 2 register. In another director register, we have director service contracts. So you need to maintain the particulars of that, a record of all the particulars. So there should be a register of person with significant control in a company, and significant control comes where you have more than 25% of shares or voting rights. So then it is said that you have significant control. It could be institutional investors as well. And a register of meetings where you would put all the details regarding the meetings. The chapter is going to come in the next session. And then we have register of charges. Charges we'll discuss in the coming chapters. And yes, accounting record and annual financial statements. So all these particulars are basically demanded from the company, and you have to submit them to the registrar. So you can see all these registers, all these books, annual accounts, annual returns, and accounting records. Let's have a look at some more questions. In which of the following circumstances must a public company re-register as a private company? If the market value of its shares falls below the nominal value, if it has made trading losses for 3 consecutive years, if it fails to pay its corporation tax, or if its share capital falls below 50,000. Well, that is the requirement for a PLC, share capital to be 50,000. If it falls below, yes, you need to re-register as a private company. Which of the following roles is not performed by the registrar? Issuing each company certificate of incorporation, that is what registrar does. Registering companies that will be sold off the shelf. Filing a copy of each company's register of members. Filing copies of each company's special resolution. Well, the answer is B. If the company is sold off the shelf are the companies who already exist and you go and just buy them. So it is between the buyer and seller. Registrar has nothing to do with that. A promoter sent the documents needed to register a company to the registrar on 1st January 2001. The registrar received the document on 4 January 2001. The certificate of incorporation is dated 6/1/2001, 6th January, and is received by the promoter on 8th. On which date was the company incorporated? What do you have to say? On which date was the company incorporated? Yes, people, you need to come up with an answer. Try and think of an answer before I tell you. Well, the answer to that is 6th January. So when the company is formed, the next step is to form the constitution of the company. Next step is to form the constitution of the company. MOA, as I told you, historic document which says that the founders, the subscribers wish to form a company and agree to become a member, taking at least one share each. And then article of association. The articles provide the basis of a company's constitution. They define the rules and regulations governing the management of the affairs of the company and the rights of the members and powers of the directors. So let's just take a break of 5 more minutes. Session will resume at 11:25. Okay, welcome back, people. So we were talking about Constitution, MOA, and AOA, Article of Association. So article provides the basis of company's constitution. They define the rules and regulations governing the management of the affairs of the company, and it is basically for the um internal rules. Provides the internal rules through which the companies would be governed. Well, we have model articles as well. There are model articles for private limited company available as well, and model article for PLC available as well. You can follow the model articles if you do not want to drive your own article, but if you want to constitute your own more articles AOA, well, you can put the rules in your company's own article of association. So basically, you need to bring up rules regarding the appointment and dismissal of directors, powers and responsibilities of directors, directors meeting, administering general meetings, members' rights, dividends, communication with the member, class meetings, issue of shares, transfer of shares, documents and records, and company secretary. All the rules that you need to govern a company are mentioned in the AOA. So, as it is written, when a company fails to register the article, the default model articles becomes the constitution of the company. Default model article becomes the constitution of the company. And once the constitution is formed, it is generally unalterable. Unalterable, you cannot change the rules. However, if you call a meeting of the members of the company and 75% vote in favor of the in favor of the alteration, then the alteration can come. Then you can alter the AOA. So the rule is that 75% of the members should agree for the alteration. We will be discussing these rules in the meetings chapter. So 75% of the member, this is known as special resolution, by the way. Special resolution is passed. Special resolution. Yes, then you can alter the article. However, still certain things are there. So as you can see, you need a special resolution or written resolution with 75% majority for the alteration. However, still the company can make it unalterable by providing members with additional votes. It is not notes, it is votes. Requiring a particular member to be present for a quorum, and you can say that this much members should be present, and then the quorum is completed, and if the quorum is not completed, the meeting is not going to start, the resolution is not going to pass, so ultimately alteration is not going to happen. Or you can have entrenched provision and you can say, no, we are not convinced with 75% majority voting for the resolution. Well, we need 100% of the members to agree. That could be a trouble in a PLC. So these are the things which can make them alterable, alteration difficult, or model articles AOA unalterable. And still we have some other rules, restrictions on the article as well. So what are the certain other restrictions on the article? Well, the alteration is not going to come into effect even if you have 75% majority, if it is going to be against Companies Act. If the alteration is against Companies Act, alteration is not going to be final. If the court orders against the alteration is not going to come. So alterations may not conflict with the Companies Act, number one. members may not be compelled. Well, there could be a court order as well that I've written over here. And through any alteration, members cannot be compelled to buy more shares or to sell their existing share. You cannot compel the members with the alteration. With the alteration, you cannot do the variation of class rights. Variation of class rights cannot be done with the alteration. You cannot remove the rights already given in a contract, and all alterations are void if the majority who approve them are not acting bona fide in the interest of the company. So alterations are void if the majority which approves the alteration, which is the 75% people who voted for the alteration, they are not acting bona fide in the interest of the company. They do not want genuine good for the company. They are just acting on their own behalf for their own interests. So these are the things which make the alteration, the AOA unalterable. So let's see. Have a look at certain questions. I think that's a repetition of a question. Which of the following party signs MOA? Well, subscribers. C is the answer. Subscribers. Which of the followings are not bound to one another by the AOA? The company to third parties, member to the company to member. It is said that AOA can act as a collateral contract between a member and another member, a member and a company and a member. As I told you, it acts like an internal document. So it cannot bound a company to a third party. So the question is, which of the following are not bound to another by AOA? Companies to the third parties. The answer is A. So the Constitution AOA can bound a member to the company, members to other members, and it can also act as a supplement to other contracts. So as I told you, the rules for the company names, it must end with LTD or PLC. You cannot have identical names. It cannot be offensive. You need official approval for official connection. Yeah, so these four main rules you need to know. And passing off is when the business as well as the names, they are so much similar that they can confuse the third party. So business and the name both have to be similar to such extent that they can confuse the third parties, and you can take the case of a company name to the company name adjudicator, and adjudicator will look into the matter, and if the adjudicator sees that yes, passing off is being committed over here, the adjudicator is going to give the notice to the company to change the name. To which company? To the company which has registered before, or to the company which has registered later? Well, of course, to the company which has registered later. That company has to change its name. Which of the following is not something that would be found within model AOA? In AOA, what you cannot find, clauses relating to the rights of the members, clauses related to the transfer of shares, clauses relating to the mission statement of the company. Well, generally, mission statement is not found. So how the company is governed, what are the certain situations, those things are found over here. Mission statements are not generally found in AOA. Which of the following changes to a company's AOA is void, is not okay? Changes that allow a member additional votes so that they may block company resolution on certain issues, changes that restrict the objects of the company, changes that conflict with the Companies Act. Which of the changes to company's AOA is void? Well, changes that conflict with the Companies Act. That is the answer. Okay, let's have a look at some other questions. Which of the following is true regarding the content of model AOA? The content of model AOA is the same for all types of companies. The content of model AOA includes clauses relating to the remuneration of the companies. The content of model AOA includes clauses related to the ethical treatment of the supplier. The content of model article of association includes clauses related to the communication with members. Well, it is not same for all the companies. It does not include anything regarding remuneration of the employees or ethical treatment. Well, it is regarding to the communication with the members. D is the answer. Which two of the following are included in the content of a company's MOA? Sorry, in the company's model article of association, AOA. Payment of dividend. Well, rules regarding dividends are mentioned. Payment of charitable donation, formation of a remuneration committee, or appointment of directors. Well, the answer is C. Remuneration committee. It is not mentioned in AOA. So these are the certain rules regarding the AOA. So we started off with the concepts of learning different companies, that what would be the consequence of company formation, company's consequences when the company is formed. What are the consequences? Well, separate legal entity is formed for all the legal purposes. Separate legal entity concept is established, and then we saw that how the veil can be lifted for some of the concept, how the veil can be lifted, and then we moved on to the formation of the company. We have formed a company, and then we moved on to the formation of the constitution of the company. Two major things that we have studied is MOA and AOA. Meetings are also part of the constitution, but we will study about them in the meetings chapter. They're also part of the uh, constitution. So now we have formed the company, we have formed the constitution. Now we need money and we need capital, and one of the source through which we can get the capital is the share capital. The companies would issue share capital, and the companies would get money from the shareholders. So what are the shares? A share is the interest of a shareholder in a company, and it is a sum, basically sum of money for the purposes of a liability in the first place and of interest in the second. Liability in the first place and interest in the second. So it is a combination. Basically, the share capital, we talk about the nature of the share capital, liability plus interest, and interest is paid in the form of dividend. Interest is paid in the form of dividend. So the different sorts of capitals are loan capital and share capital. First, we are going to talk about share capital. Share capital is the type of class, number, and amount of shares issued and allotted to the specific shareholder. So, what exactly is the share capital? In share capital, we say that share of this class, share of this amount is issued to this particular shareholder. And when we issue shares, the equity share capital is a company's issued share capital less capital which carries preferential rights. Equity share capital normally comprises ordinary shares only. So when we issue share capital, the company would want the shareholder to put in the money in the company. Well, some of the amount of the share capital could be paid up and some of the amount could be left called up. Paid up is the amount that you have already paid to the company, and called up is the amount that is still yet to be paid, and it is paid whenever the company wants it and or in a condition which is liquidation. If liquidation occurs, all the called up share capital is immediately called up by the company and the members are supposed to put in the called up amount of their share capital. The dividends are normally paid on the paid up amount, the money that the company has already received. And issued and allotted share capital could be another part over here. So different types of share, talking about different types of share capitals. The two broad categories that we can put over here is ordinary share capital and preference share capital. Ordinary and preference share capital. The ordinary share capital has certain rights and preference shareholders have certain rights. Preference shareholder, difference between preference and ordinary share capital is that the preference are promised dividend at the fixed rate, dividend at a fixed rate, and they're promised dividend before anyone else gets it. So the two major rights are that preference are going to get the dividends at a fixed rate and preference are going to get the dividend before anybody else gets the dividend. So ordinary shares entitle the holder to a company's remaining divisible profit and assets after the prior investors, and preference shares carry a fixed rate of dividend paid in priority to any other dividend. Two major distinctions: fixed rate and paid in priority to any other dividend. The preference shareholders have certain rights. The right of a dividend is usually cumulative. The dividends are usually cumulative and they are paid whenever the company has amount, the cash, then it is paid. In liquidation, holders are usually entitled to unpaid dividend arrears. There is no entitlement to participate in dividends above the fixed rate. Well, after you have got your dividend according to the fixed rate, well, no dividend above the fixed rate, above the fixed rate. So whatever is left for the ordinary shareholders. So ordinary shareholders are entitled to the remaining profit after deducting the preferential claims. After deducting all these preferential claims, ordinary share capital has a right to vote. Preference cannot vote. No voting right. No voting rights. Ordinary share capitals have a vote to bonus issue. Preference has no bonus issue right. They cannot ask for the bonus issue. Likewise, there are shares which are issued for a time period, and after that time period, they are repurchased by the company. And so, company can even reissue the shares with usual formality as treasury shares from out of the treasury. Let's see, have a look at some questions. What is the amount of nominal share capital that has been paid for the company's members' call? Paid up share capital, issued share capital, allotted share capital? Well, from the issued share capital, the amount which has been paid is known as paid up share capital. So if you know the rules, the questions are going to be simple, plain, with plain ordinary meanings. So you need to remember all these rules. Which of the following sources of company finance is classed as equity but typically carries no voting rights? Ordinary share, preference shares, secured debentures, unsecured debentures. Well, who does not have voting right? Preference shares. Preference shareholder. So these are the certain rights that ordinary and preference shareholder gets. Well, can we change these rights? The question is, well, can we change these rights? And which is known as variation of class rights. Variation of class rights. Well, you cannot normally do that. Variation of class rights involves alteration of the position of the shareholder. You're going to vary, well, it is going to alterate the position of the shareholder. If you want to make that variation, you need to do that with the consent of the holders of the shares and majority specified in the articles. And what is the majority? 75%. You cannot normally do this, but if you want to do it, if you want to change the shareholders position through what? Through variation. Well, you need to get, number one, consent from that shareholder, number two, consent from the majority, and the majority that is specified is 75%, special resolution as it is for AOA. If they agree, then yes, you can alter that. A minority holders of the class of share may appeal to the court about the variation. Well, if you are going to call a class meeting of that particular class, and for example 80% agreed to the variation, then the 20% would be the minority who did not agree to the variation. So minority can go for a claim if they together hold 50 more than 50% of the relevant shares, have not consented to the variation, and they can apply within 21 days. So there are certain things where the holders of that certain shares, they think that this is variation, but actually law says that it is not variation of class right. When does that apply? Well, issuing shares in the class to others. If you are going to issue shares to other classes, that is not variation of shareholder, variation of class right. Subdividing other classes of share within a share class, if you are going to subdivide the shares, that is not going to be the variation of class right. Returning capital to the preference shareholders normally gets their capital back after a specified time period if they are redeemable. So we are going to return them. That is not variation to your rights. It is an extra right that is given to them, creating or issuing new forms of preference shares. So if another class of preference share is issued, for example, the first preference share was 6% dividend, you issue another preference share class of 8% dividend, that is not variation of class right. Company can issue whatever amount of classes of shares they want to. That is at the discretion of the company. And the next other things, basically shares are allotted by the director. So who issues shares in a company? Director issues share in a company, and the value of share is known as nominal value or face value of the share. Who has the authority to issue the share capital? Well, director has the authority, and that authority is given in the AOA, given by the members to the directors. And shares have certain nominal or face value. For example, £100 per share. Shares can be issued more than the nominal or face value. So issuing shares at an amount greater than the nominal value would give rise to share premium. Share premium, and share premium is a reserve, and this reserve cannot be used for any purpose. Only you can use it for the issue of bonus shares or for some preliminary expenses of regarding issuance of shares. So can the shares be issued at below the nominal value? Below the nominal value? Well, the answer is no, generally not. However, we have some exceptions. One of the exception could be bonus issue, when nothing is paid but the share is issued. We'll talk about bonus issue in a while. One of the exception is partly paid shares. One of the exception is underwriter fee, which is deducted from the share, and ultimately the consideration that we get is below the nominal value. And one of another exception is money's worth. When you do not get money in return of shares, you get something money's worth, and eventually when that thing materializes, it amounts to a little lesser amount than the nominal value. So these are the issues regarding the price or value of the shares, and normally directors allot the shares. So in the context of company issuing shares, which one of the following is forbidden by the Companies Act? Issuing shares at a premium to nominal value, issuing shares at a discount to nominal value, issuing partly paid shares, or issuing bonus shares. Well, discount to nominal value. You cannot issue shares below the nominal value normally. In the context of companies finance, which of the following is usually repaid first on liquidation? Floating charges, ordinary shareholder, fixed charge holder, or preference shareholder? Well, fixed charge creditors are paid first and then the preference shareholder. Sorry. Fixed charge creditors are paid first, but if you talk about shareholders, ordinary and preference, if you have given a right to preference for the preferential claims, then only then they are paid first. So in all four of them, fixed charge creditor is paid first at the liquidation, and if the fixed charge creditor has taken the particular asset away, and when we are going to pay, we are left with floating charge, ordinary shareholder, preferential, the answer is floating charge. The answer is floating charge. Shareholder gets the money at a later stage. At a later stage. So, two more topics, bonus issue and right issue. So, bonus issue and right issue. Whenever you're issuing shares, so whenever you want to issue bonus issue, so bonus issue is given as a gift, as a bonus to the existing shareholders. Which existing shareholders? Existing ordinary shareholders. Ordinary shareholders, and nothing is taken in return of that. And they have been awarded with extraordinary shares. That is not a right for the preference share. Not the right is not given to preference shareholders. Right issue, whenever the company is going to issue more shares, whenever the company is going to issue new shares, when the company will be issuing new shares, it is said that you need to first offer these shares to the existing shareholders, pro rata to their existing shareholdings, pro rata to their existing shareholding, so that if they say yes to the offers and if they buy these shares, this is not going to change their weightage of their shareholding in the company, which is the main purpose of right issue. Number two, you need to offer them at discounted value, at a discount. Offer them at a discount. Preemption rights or right issue, preemption rights, the name of the right issue, are the rights of existing shareholders to be offered new shares of ordinary shares pro rata to the existing shareholding. And right issue is a right given to the shareholder to subscribe for the further shares in the company, usually pro rata to the existing shareholding. Bonus is the capitalization of the reserves of the company. Bonus issue is the capitalization of the reserves of the company. So let's take a break. The session is going to resume at 12:10 p.m. 10 minutes break. See you on the other side. Okay, students, welcome back. So this was all about preemption rights, right issue and bonus issue. If you have any questions, you can put that up in the question box. So as I told you that if you have the good issue shares at a premium, it is going to lead to premium reserve, share premium account, and that share premium account will basically you cannot use that share premium reserve, but you can only use it for these two purposes: to create fully paid up share or to pay issue cost of the commission in respect of a new share. So now let's see if you can answer. Just give it the reading. Give these questions a reading by yourself. Okay. So which two of the following statements regarding preference shares are correct? A company is compelled to pay dividend on preference shares every financial year. Preference shares do not normally entitle the shareholder to vote in company meetings. Preference shareholders usually have a right to have their capital returned in the event of a liquidation ahead of the ordinary share. Well, this is not usually given, but you can give this right to the preference shareholder. In the event of a liquidation, excuse me, preference shareholders have the right to share in any surplus assets ahead of the ordinary shareholders. C is not the answer, D is not the answer. So we are left with two options, A and B. At times, the examiner would want you to pick up two options, but for that sake, he would be highlighting the word two as it is written over here. So A and B is the answer. Next question, which of the following statements regarding issuing shares is correct? Shares must be issued at their nominal value. Shares may be issued at a discount to their nominal value. Shares may be issued at a premium to their nominal value. Well, if you need to correct, choose one statement, it is A. Shares must be issued at the nominal value. Generally, that's what law says, but shares may be issued at a premium to their nominal value as well, if the market value allows that, but share cannot be issued at a discounted value. So C could be answer, may be issued at a premium value. So let's talk about some more questions. With regard to share capital, which of the following constitutes variation of class rights? Issuing shares of the same class to the allottees who are not already member of the class. That means issuing more shares. That is not variation of class rights. Returning capital to the preference shareholders. As I told you, that is not variation of class right. Subdividing shares of another class with the incidental effect of increasing the voting strength of that other class, or changing the amount of dividend payable to a class of preference shares. Well, D is variation of class right. You cannot change the amount of dividend that has been already decided for preference shares. Which of the following describes a company's called up share capital? the amount the company has required shareholders to pay on existing shares, the type, class, number and amount of shares issued and allotted to shareholders, the amount shareholders have paid on existing shares, the maximum amount of share capital that a company can have in an issue. Well, A, the amount the company has required shareholders to pay on the existing shares, which is still to be paid, it is called up. Which is still to be paid, it is called up. Preemption rights are granted in which of the following situations? A company proposes to allot ordinary shares wholly for cash. A company proposes to allot ordinary shares. A company proposes to allot preference shares wholly for cash. A company proposes to allot preference shares. Well, the answer is a company proposes to allot ordinary shares. Which of the following statements regarding payment for shares is correct? Public company shares must always be paid for in cash. At the time of allotment, a public company must receive payment of at least 50% of the nominal value of the shares. Private company may allot shares for inadequate consideration by accepting goods or services at an over or under value. That is true. Sorry, not over or under value. A private company must have non-cash consideration independently valued before accepting it as payment for shares. Well, the answer is D. When a private company have non-cash consideration, it should be properly independently valued. So these are certain issues regarding the share capitals. Whenever the company needs funds, the two broad sources of capitals are share capital and the next is loan capital. Loan capital. So what is loan capital? The document that is given in exchange of loan capital is known as debenture. Debentures are issued as loan capital. It could be of any amount and any rate of interest decided between the parties, for example, a company and a bank, and at the maturity date, it is going to be paid back. It's going to be paid back. So when talking about debentures, we have certain categories. For example, you can have single debenture. Single debenture, the company is going to take loan just from one party only, one party, so that they have preferential claims at the liquidation. They are the only creditors available which the company has to pay, so they are at the highest rank of creditors to be paid back. Then a company can have series of debentures. Companies can have series of debentures. Company can have few people from whom you have taken the loan. They can differ in amount, but they prefer that they are same in the ranking. They are similar in the ranking. They can differ in the amount, but they prefer that they are similar in the rank. Series debenture. And then finally you have stock debenture, debenture stock. Debenture stock is when a unit is identified for the loan, for the debenture per unit. For example, 1 unit for £100 And just like shares, you can opt for as much units as you want. So stock is normally name used for share capital. So debenture stock is that category of debenture which is just like share capital, and certain units are identified and you can buy as much as units as you want, and you can even sell some of them in the money market just like shares. But for these type of debentures, you need to maintain a deed which is known as debenture trust deed. It is to be maintained for these type of debentures. It is a compulsion for debenture stock. It is a compulsion for debenture stock, compulsory. And there should be an officer who should be maintaining that deed and maintaining all the information regarding all the relevant debenture holders. Moreover, there are certain types of debentures. The debenture could be unsecured debenture, and the debenture could be secured as well. Loan capital could be secured as well. There could be some sort of security, and secured debenture is further divided into two categories. Fixed charge, whenever the debenture is secured, we say that it is charge. A charge has been created. Fixed charge debenture and a floating charge debenture. Fixed charge holder and a floating charge holder. So how would we distinguish them? For a fixed charge holder, the asset is specified. If the company is unable to pay the debenture holder the amount, the debenture holder, the fixed charge holder, can come and take the assets from the company. They can take the asset away from the company and recover its amount. Asset is specified. However, in a floating charge, the asset is not specified. At that time, you can come and choose any asset. So it is said that it keeps on floating on the assets. Fixtures and fittings, land, receivables, and buildings and stock. So the charge keeps on floating until and unless the charge holder puts their finger on any one asset and specifies the asset. And the second distinction is that, which is more important actually, in a fixed, if an asset is under a fixed charge, dealing in that asset, selling or purchasing transactions in that asset is not allowed until and unless you pay your debt fully. However, in a floating charge, dealing is allowed because the asset is not specified. The asset is not specified, so the dealing is allowed. This is the major distinction between fixed charge holder and a floating charge. So these are the different charges that can be created and that can make the debenture a secure debenture. A secure debenture. So fixed is better than the floating charge. And crystallization is the process that occurs when a floating charge is converted into fixed charge. So whenever the holder of the floating charge comes and specifies the asset, the floating charge is converted into fixed asset, and this whole process is known as crystallization. Crystallization. This is the whole process of crystallization. It occurs when the times come. It occurs when the company goes into liquidation. It occurs when the company announces the cessation of the business. So there are certain circumstances when crystallization occurs. It's an important process. Crystallization, it occurs when a floating charge is converted to a fixed charge. So talking about the priority of payment under certain charges, if we talk about priority of payment under certain charges, so if we have two charges, so 1st January and 1st February. So if first charge is created on 1st January and it is a fixed charge, and another charge is created on 1st February and it is also a fixed charge, so which one gets the priority? Through nature, both of them are same. No one gets the priority. However, through timing, 1st January would get the priority. The person who entered into a fixed charge contract on 1st January will get the assets. Whenever a floating charge is created on 1st January and a floating charge is created on 1st February, through nature both of them are same. The person who entered into a contract on 1st January, which January under a floating charge, will get the priority. So the contract is of fixed charge on 1st January and of a floating charge on 1st February. Through nature and through timing both, the charge of 1st January will take the priority. So if a charge floating is created on 1st January and fixed is created on 1st February. So through timing, the floating gets the priority. Through nature, the fixed gets. Ultimately, fixed is going to get the priority, but only in one condition the floating charge gets the priority. If when the fixed charge entered into a contract, it is a term of their contract that there is a prior floating charge and it would get priority over your charge at time of liquidation. Only then the floating charge gets the priority. Only then the floating charge gets the priority. Otherwise, this gets the priority, this gets the priority, this gets the priority, and this gets the priority. So this is going to get the priority only in this condition. And who borrows in a company? You talk about debenture. Debenture is borrowing. When you borrow money and you pay interest on that money, rate of interest, and at the maturity date you pay it back. So who does the borrowing in a company? Well, directors. Who has the power? Directors. Well, up to what limit? The limit that is specified in AOA. Directors cannot borrow above the specified limit in AOA. However, the AOA can be altered by the members by 75% voting or special resolution. The AOA can be altered as well. So these are the rules regarding the loan capital. Share capital and loan capital and right issue, bonus issue. So this is how the company arranges the funds through capital. However, the company distributes out of capital as well. For shares, company would give dividend, and for loan, the company would pay interest. The company would pay interest. So once the capital has been arranged, the share capital has been arranged, you need to maintain that share capital. You need to maintain the share capital, which is known as share maintenance, capital maintenance. You cannot pay money out of the capital. However, at times law would allow you to do reduction of the share capital. At certain moments in time, the law would allow you to do reduction of share capital. So when will law allow you to reduce the share capital? Generally, it is said that companies should maintain their share capital. Why? For the sake of creditors. Because creditors know that share capital is the amount that is always present inside the company. So they would be paid out of that if the company would have no excessive funds. So for the creditors' detriment, the capital should always and always be maintained. However, at times reduction is allowed. When is it allowed? If your company's AOA permits. If AOA does not allow, you can alter the AOA. You can change the AOA. Or from the court order. How can you change AOA? By 75% voting. Or you can get a court order. So if any one of thing you can manage, you can go for capital reduction. Why would a company want to reduce its share capital? Company might want to expel the interest of some shareholders completely, especially the ones who started competing with the company. Minority expulsion. If a minority starts to compete with the company might want minority to be expelled out of the company. And the company want to replace share capital with loan capital, because interest is tax deductible. Interest that we pay over here is tax deductible, and dividend is not. So company might want to replace the share capital with loan capital, or the companies have suffered loss on value of assets. The company might say that they have suffered devaluation, suffered loss at revaluation. So when the permission is given, how can you reduce the share capital? First of all, if there is anything paid, anything in called up share capital, you can cancel that. If you don't find anything in called up share capital, pay out of the paid up share capital and pay out of surplus asset. And if you do not have any surplus asset, as you have loss of asset, you can pay it out of the reserves. Reserves when you have a debit balance on the reserve because of the revaluation, you can always cancel it by reducing share capital. So if you do not have any surplus assets, a debit balance on the reserves could be used to reduce the share capital. So these are the rules for share capital. And what else regarding the shares? Well, regarding the shares, what else you should know is the rules for dividend, dividend, well, profit available for distribution is accumulated realized profit minus accumulated realized losses. So that is the equation that you need to remember when you want to go for distribution of dividend, both for private limited and public limited. So if for year 2011 you have a loss of 1 million, year 2012 you have loss of 2 million, and year 2013 you have profit of 6 million. Well, the available profit for distribution is 6 minus 3 million. It has to be accumulated. It has to be accumulated. So this is both for public limited companies and private limited companies. For PLCs, there's an additional rule as well. So their net assets should always be greater than a sum of called up share capital plus undistributed reserves. A PLC can only give the dividend if their net assets are equal to or greater than a sum of these two. Sum of these two. If you add up these two, called up share capital and undistributable reserves, for example, share premium, revaluation, capital redemption, all these reserves come under undistributable reserve. So for a PLC, there's an additional rule. Whenever your net assets are less than the sum of these two, you are not supposed to pay the dividend. You cannot supposed to pay the dividend. You cannot supposedly pay the dividend, and if you do so, well, you will be liable. Well, what happens? What happens when a greater dividend is paid? Greater dividend than the specified amount is paid. Who is liable? Directors are liable, because directors are supposed to announce dividend. Directors are supposed to declare dividend. Directors are liable. And if the members who know that knowingly they are receiving greater dividend, they are also asked to bring back the money. But if the members are innocent, they do not know that, then the directors have to make good. Directors have to put the money back to the company. So these are all the rules regarding capital and share capital, loan capital, and capital. distribution, capital maintenance, capital reduction, and dividend distribution. So if you have any questions, you can ask. If you have any questions, you can ask. So we have talked about certain issues regarding the established areas for share capital, for company constitution, company formation. Tomorrow we'll be talking about some more areas of English legal system, and all the handouts are available in the handout session for all the 3 days recordings. So if you have any questions, you guys can ask. Okay, so keep revising these areas. Tomorrow we are going to talk about some other areas of English legal system. Well, Hasib, the new updates would be discussed in the discussion. There are some of them in the Bribery Act, money laundering. All these are the new updates. Nothing majorly is changed. We have still not talked about the MTQs. We'll be talking about them in the coming days. So thank you for joining in today. That is all for today. Do join in tomorrow as well. Thank you. Allah Hafiz.